Continuing from the previous discussions, let us talk about accrued expenses. Accrued expenses are costs that are already incurred in an accounting period, but are unrecorded and unpaid, meaning expenses should be recognized, but there are no actual cash disbursements yet. Adjusting entries that involve accrued expenses increase the expense accounts and the liabilities account. The adjustment recognizes the expenses that are incurred during the period. Common examples of accrued expenses are unpaid salaries, rent, interest, and taxes. Here are some examples. Sally, an employee of ABC Company, earns $14 a day or $70 for a 5-day work week that begins on Monday and ends on Friday. Sally is paid every 2 weeks on Friday. Look at the calendar during the company's accounting period. The payment of their salaries falls due on December 12 and 26 and is already recorded in the journal and posted in the ledger. If you look at the calendar, the next payday of the employee would be on January 9, 20x2. However, the accounting period of ABC Company ends on December 31, 20x1. This means Sally has worked from December 29 until December 31, but remains unpaid since she will only be paid cumulatively for the 2 weeks on January 9 of the next year. The problem is, how do we record the December 27 to 31, 20x1 salaries, even though it will be paid on January 9, 20x2? Just like the accrued revenues, here's a review of the process. The company incurred the salary expense from December 29 to 31, 20x1, but by the end of the accounting period, payment remains unpaid and unrecorded. That means Sally's salary on these dates was only incurred but not recorded on the books. On December 31, 20x1, 3 days have already passed. ABC has neither released nor recorded the salary of Sally. To compute for the accrued salary of Sally, the daily rate of $14 multiplied by 3 days will give you the answer. The alternative solution would be the weekly 5-day workweek salary of $70 multiplied by the number of days earned divided by weekly days of work will give you $42. To adjust for the amount of salaries expense or accrued salaries expense, debit the accrued salaries expense or salaries expense account for $42 and credit salaries payable for the same amount to record the salary incurred by ABC Company. The amount of $42 will be paid on January 9, 20x2 together with the other days that will be earned by Sally. Then again, on December 31, 20x1, that $42 is a liability of ABC to Sally. In the previous discussions, we discussed interest as a revenue of the lender. Similarly, interest can also accrue as expense in the books of the borrower. Let's use the same example that was previously given in the accrued interest revenue, but we'll do it on the part of the borrower. On October 1, 20x1, XYZ Lending Corp. lent $600 to ABC Corp. with a 12% annual interest rate, payable on September 30, 20x2. On the reporting date on December 31, 20x1, the interest incurred will be $18, derived by multiplying the principal amount with a 12% interest rate multiplied by 3 months earned and divided by 12 months. Take note that the interest rate is for 1 year. Thus, we used 3/12 and multiplied it to the interest rate of 12%. ABC Corp, as of December 31, 20X1, has the obligation to pay the incurred interest worth $18. This amount will also be recorded as the accrued interest expense of ABC Corp.